What is coming up for the stock market? Can it continue to rally? I'm going to talk about it. I am Dr. Stock, Doctor of Education, and I was sitting in sports medicine the other day, waiting to see the doctor. I saw Santa Claus limping in. He said, "What's wrong with you?" I said, "I got tennis elbow." I said, "What's wrong with you?" He goes, "I got chimney." So I got asked this morning over in the Discord, what do I see happening with the market? Do I still see it selling off in January? And I did say in my other videos that I thought the rally that we're seeing could extend through December, possibly into January. And I'm going to give some context surrounding that by looking at the charts and doing a little bit of commentary and technical analysis, talking about not only the stock market, but also the bond market, because I think both of them are very much worth paying attention to. And we're going to tie the Fed into that as well. And if you guys want to see how I'm playing this market, I'll tell you about the Patreon, I'll tell you about my options course, and about the free stocks from Moomoo. In the meantime, let's get right into trading economics. We'll talk about what's coming up for the week, and then we'll start talking about the market itself. So for this week, going back to Monday, we don't have a whole lot that I can see really coming up for us that are going to be major catalysts. Same thing for Tuesday, and we can just keep on moving right along. We have jobs reports coming up, initial jobless claims, and GDP on Thursday, December the 21st. So we'll watch for that, and it would be nice if we got another upward revision on GDP. Now, mind you, I don't expect it to move as much as the last time, so we were at 4.9 up to 5.2, and we'll see if we hold steady at that 5.2 that we have, or if we get bumped up, which would be, in my opinion, a good thing, or if we get bumped back down from that estimate that we got before, which I think could be a little bit dicey for us, because it could talk about a little bit of unexpected slowdown, even if it is still a very healthy number, but that fits into the larger context of this video. So we have GDP coming up. That's going to be big for us. We want to watch for that. And then we have personal income and outlays on Friday, December the 22nd. So that was actually a little bit early for us this time, thanks to the end of the new year and closing out the year of the stock market. So we would be watching for that one coming out. It's the final inflation report of the year. I do anticipate good things. We'll be watching that as that comes closer, as that day hits. And I think that that's going to be something that's going to come in at nice, steady, and unsurprising for us. So we'll see how that plays out. That is the other catalyst besides GDP and initial jobless claims on Thursday. Otherwise, I think the first 3 days that the economic reports that we have are pretty unremarkable. So let me bring that down for a moment, and I do want to talk about the markets themselves. So we had the Fed come out and give us a very dovish tone, which was very surprising. And then also looking out to 2024 and 2025 for the target federal funds rate, where the midpoint was for where the Federal Reserve Board thought that the federal funds rate was going to be, and we got rate cuts that we didn't expect to see on there, and then the market really rallied off of that. So I want to talk about that rally itself and where I think that money came from. So there's a few things that I think that we need to look at. So let's put up the chart first for the market. Look where we've come from. So when we're looking at this is the SPX. So this is the S&P itself. So this is the index values, not the SPY, which tracks the index. This is, like I said, S&P itself. We're getting near that overbought territory with the RSI 12 that we have on here. And when we look at that, we actually are still 1.7% away from the all-time high. So what does that mean for the index then? That means that we could possibly rally a little bit more. Now you'll notice I have a bunch of trend lines and resistances and supports drawn on here. Let me zoom in a little bit more. So what we would do if we took 1.7% and tacked it on to what we have for the index, if we're going to continue to rally towards that all-time high, that puts us right at this yellow line that I have up here, which is about 480. So that'd be pretty cool for us, because that's between 2 and 3% that we could see that movement moving up in SPY. So that could be a good thing for us. Now, mind you, we also have these lines, and this one could sort of act as resistance for us, and it's possibly come back down. We start testing the support, because if I do actually take out some of these lines that you see on here, what we can see start to appear out of that is a bit of a bullish channel that we've been operating in throughout 2022 and into 2023. So since that market bottom that we had with the inverse head and shoulders play, moving up there, and that would put us at the top of the channel. Now, mind you, we have another one to look at here, which we don't have another touch point, which would be nice to have another touch point, which we have a fair amount of confluence going on there. Landings around that 480 mark. Now, I do also want to show you another view of this, another interpretation. If we put on a Fibonacci retracement from top to bottom on this thing, let me click it one more time. There we go. So from top to bottom, so from a previous peak that we had here to our previous bottom, where can this go? That says 483.58. So that would be 3 to 4% up from where we closed at the last time. So we want to keep an eye on that. I think either one of those things are possible. Should we be able to keep on climbing? Now, about that climb, this is a comparison between what you see in the candles on the bottom part of this mostly is the US 10-year Treasury yield, and what you see in orange is the S&P 500. And there's some interpretations that you can do from this. So if we go from the time of the pandemic, when you see the drop in the S&P here, you also see a drop in the bond yield. So what we see in that is that flight to safety where the bonds are being purchased heavily. So you get a significant drop in the bond yields, and the Fed stepped in and helped keep that steady. And because they did step in, plus economic stimulus coming out, that's where we get that sharp rise here in the markets. And then when they start moving together, that is more of a risk on environment that we're in. And why that is because we see the stock prices moving up, but the bond yields, in this case, the 10-year Treasury yield, is also moving up. So that means that there's not as much of that 10-year Treasury being purchased. So that means that there's less demand for that thing, whereas you see more rise in the market. So to me, that's a risk-on type of environment. And then when you start to see them move differently like we have here, this is a distribution of cash, in my opinion, that we're seeing distributed to the market. So up in the stock market, down in the bond yields is actually up for the bond market. So the bond prices go up and the stock prices go up. That's a deployment of cash to those markets. So then moving on from there to where more recent history as we have it here, what we saw going from, it looks like May all the way until we get to the middle of July, we have both of these charts moving up together. So what is that? Well, that is an increase in what we see for the stock prices, but that is also less of a demand for the bonds coming out. So what that means is that we are risk on up until July, and then we have a drop in the stocks and also a drop in the bond prices, which is the rise in the yields that you see here. So what we see in that environment is a move to cash. And so this move that we have here, where they're moving in opposite directions, I think that this is actually cash being deployed to both markets. And I don't think that we're in that risk-on environment. As a matter of fact, right now, I think that risk-on environment would be bad. So let me grab the paintbrush here, and I'll show you why I think that risk-on would be bad for us in the near term. So paintbrush, where are you? Help me out here. There we go. There's my paintbrush. So this is what we have right now, and this is deployment of cash because we have a drop in the bond yields and a raise in the stock prices. So that means actually also a rise in the bond prices themselves. So that right there, that is cash being deployed into both markets. Now, risk on, what that would look like is that we would have an increase in the stock market, but we'd also have an increase in the bond yields. And we don't want that increase in the bond yields when we're up as high as we are right now. And the reason that I say that, and I think it comes back to the Fed and why the Fed is eager to come out dovish, I think goes a lot to what we see in the economic reports. So let me show you just a few things that I'm thinking of as I talk through this. There we go, and let me pop that back up. So right here, this is the assets, liquidity, and credit facilities, the loans bank term funding program. And so for this one, this goes all the way back to March when we started getting possibly into that banking crisis, and we didn't want all the banks defaulting in a banking system collapse, and this allowed that to exist. And you can see it went flat, going from about June 7th all the way with very minimal rise up till November 1st, and then it rose a little bit more, and then it rose a little bit more, and bond yields have been falling throughout that time. And yet what we see is this increasing anyway. So that means that banks are still using that lending facility. And the problem with that, let me go over to the next tab, is that is set to close on March 11th, 2024. And the thing is, could the Fed go through and extend that? And the reality is that the Fed could go through and they could extend that backstop if they needed to. But what that would signal to the market and to the economy was that the banking issues still exist. And they're trying to say that the banking issues have subsided, or that we're not seeing the same risk or fear of default for the banks. And so I think that as we get near that time, the closer to that date drawing, I think that can be something that really starts to put downward pressure on the markets, the stock market themselves. And so what the Fed wants to see is a drop in the bond yields, because that's going to be much better for the banks, because that also means that we have an increase in bond prices, which means that when those banks go to pay back their loans and get their stuff back, that they actually don't end up as upside down as they were before and end up in a liquidity crunch with the fear of the bank runs happening, because the bonds that they purchased that were supposed to be long dated treasuries were something that just weren't worth as much because there was no real market for bonds at the time. So what we want to see in the markets, and something that would make this very safe, actually let me put myself back up here for just a moment. What we want to see in the markets, we actually want to see those bond yield prices continue to decline for a little while longer. And I think there could be enough cash still sitting on the sidelines, enough cash to be deployed where we actually still continue to see that drop in the bond yields for the time being. And we also see more cash going out to the stock market as well, which could also cause that to rally for a little while longer. So to me, cash deployed, I think there's still cash on the sidelines that can still go to both markets. But as sentiment changes on one, we got to be very careful for that, because if we see an increase in the bond yields themselves, that's less demand for the bonds, which is trouble for the banks when March comes around. And so for the stock market, then that can also mean trouble for that as well, because that could be something very scary that could bring a lot more fear, uncertainty, and doubt into it. So we want to be on the lookout for that. So let me put up a few final things here. First of all, January, for the meeting, we're seeing a 10% chance for a rate cut in January. And I have to say that if the Fed does toss that rate cut out there, that's kind of a mixed bag, because that could be the Fed cutting rates sooner than expected. And, well, so they could possibly see trouble brewing, trouble in the horizon. Maybe it's that those bond yields haven't dropped quick enough, and maybe that there's not enough demand for those bonds yet to really ensure safety in the banking area. So we're going to have to watch for that. And then if we go out to March for this one, and this is incredible, this is since the Fed meeting, we actually have, what does that come out to be? 68, 69% chance of 1 to 2 rate cuts by the time that March comes around, and well over half a chance that we see that first rate cut happen in March, which is pretty incredible. However, March 20th is the projected date of that meeting, and March 11th is when that window was supposed to close here. It's set to close March 11th, 2024. No more lending program. So it's kind of a pickle coming up for the Fed, which means that it could be a pickle coming up for the markets, and it's something that we actually want to watch for. So I do think the markets could continue to rally through December and into January. I think that possibility is most definitely out there. I think that we have room to the upside. I still think that there's capital to be deployed, but I do think that we are not out of the woods yet, because I don't think that we've entered that risk on environment where we're actually going to see risk assets, such as in the crypto market, which, by the way, is also worth mentioning. I don't think that we're in that risk on environment where it really sends us just skyrocketing up in the markets. I think we could still drift upward for the time being. I do think that if we do sell off in the near term, that will bounce and then continue back up from there, because we are near that overbought territory. So that could be something that allows the market settle for a few days and then take off again, or the market settles down for a little bit for a few days and then takes off again. But as we get through January and that whole February, March timeframe, I think that's where that we can really start to turn the corner on that. Now we're going to have a little bit of a scare, a little bit of a fear coming into the markets, and we're going to have to play it from there. Now, it's hard enough to talk about what's going to happen in the market a day ahead of time, let alone a week ahead of time, let alone months ahead of time. But these are ideas that we want out there and that we want to talk about and we want to discuss, because we don't want to get caught behind the market, because that is a rough place to be. Then sometimes it's hard to jump in for those opportunities. So the last thing on that, and then I'll wrap things up for you guys. So when we're looking at this, actually, let's go to Bitcoin for a moment. We had a lot of movement in Bitcoin, and some of that, is this risk on? And I thought for a while that it was, but now I'm thinking that it's not so much risk on. I think this is Bitcoin ETF. I think that we're also seeing more capital being deployed back into the markets, but I do not yet think that we're in that risk on environment. But I do think that when we get to the risk on environment, that crypto is going to do incredibly well. So we're going to have to watch and see what's coming up for us. Going out to the SPY here, like I said, we're in the overbought territory. Even if we go out, we're even looking at the weekly chart, we're starting to hit overbought. And if we go to daily, then we are significantly overbought when we look at those charts as well. So is there room to the upside? Absolutely. There is room to the upside, and we should be looking for it. If you guys want to see how I'm playing these markets, you can do so by using the link down in the description for the Patreon. I have my Tesla stock price prediction, Nvidia stock price prediction. They're both down there waiting for you, ready to go. Also, my Discord is available over there as well. And through that Discord is where I post my buys and sells. You can see the exact things that I'm using in this market in order to make my profits. And I use options very often for those profits. And you can check out my options course that I'm building out over there right now. And you can get free stocks from Moomoo by using that link down in the description. So guys, markets, I do think there's more upside to be found from here. I do think that there's time that the market needs to cool off and settle a little bit, show us where exactly to find support at. That would be wonderful and perfect, because we still haven't seen it for weeks. We've gone weeks and weeks without support. We did go sideways for a little bit and then rocketed back up, but we still haven't retested support. We don't know where that next low is. I do believe it's a higher low than we saw last time, but it would be nice for the market to take its time and readjust and recover before we start moving back up again. So I do think that we We have more all-time highs coming up in the market. The SPX itself, the S&P itself, it will hit those all-time highs. The same thing for the NASDAQ. Proud to turning that corner, and I think that early Q1 of next year could be a sign where we have a little bit of trouble coming up with bond yields and banks. That's something on the horizon to watch out for, unless we get a significant movement to bonds in the meantime, which continues to drive those yields down. And that whole bank question, just expect it to be a thing at some point coming up in the near future. It's something for us to watch for. I know that I'm watching for it, and I'll be talking about it here on this channel. Thank you guys for watching. I really do appreciate it. Like I said, that Patreon link's down in the description. Come and talk with me and my community members. See my buys and sells. Get your free stocks from Moomoo. That link is also down in the description. As always, guys, I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.